All right. Welcome,
Hey Ricardo,
welcome.
how's it going?
How's it going, Rob?
Good, good. Well, we finally got up and going.
Yeah, we finally got episode 2 running here.
Started.
Welcome, everyone. So,
Welcome,
Rob, what
welcome.
are we going to talk about on this second episode of our mortgage podcast?
Well, I think today we should talk about the different types of companies in the mortgage industry. So there's basically three. There's more, but there's basically three. There's mortgage brokers, direct lenders, which kind of is a broad group, and then retail banks. So retail banks being your Wells Fargo's, FDIC type banks. They hold their own charter, kind of, in the sense that they're uh, a brick and mortar type bank. Whereas
Yeah,
a direct lender is going to be more of a in between retail bank and a mortgage broker. So they kind of operate both sides of the window.
gotcha.
So I think it'd be best if we start with a mortgage broker first. So in a general description, a mortgage broker is licensed by the state that they do business in, and then federally through NMLS. Um, and um, and they don't lend their money. They broker, just like an insurance broker. They go out and they find lenders that fit for you. So in some ways, they have more options than a retail bank. And even depending on the type of direct lender, they'll even have more options. It's when you get into the hybrid direct lenders that it can get a little wishy-washy. Um, and the mortgage broker charges a fee. It can either be an upfront fee to the borrower, or the lender can pay it. In the old days, it was convoluted, and it was kind of restructured after 2008, which I think was a good thing, because um, there were a lot of games that were played, kind of like what you're seeing going on now in the real estate uh, things that are going on. The mortgage industry kind of already went through this, where there are a whole bunch of different things to look out for the consumer. But basically, you're either going to charge a fee up front, or you're going to get paid through the lender, which is still going to cost you money, because it just means you're going to have a higher interest rate. So there's no getting around. Anybody that tells you you're getting a free loan or a no fee loan is being disingenuous, because one way or another, you are paying for everybody's services. Nobody is doing this for free like in any other industry. So even, and we should probably also throw in, if we have time, because we could get through this pretty quickly, are the ones I really kind of, I'll bite my tongue right now, but the nonprofit lenders.
Yeah, well,
Um,
let's make it clear that just because they're under the guise of a nonprofit
Not right. So that's why I
entity,
said I'm going to bite my tongue right now on that. We'll come back to it, but that's
yeah,
another option.
doesn't mean
And
that
they can,
they're not making
right,
money. They are for
and they
sure
will operate
making
under one
money.
of these three. They will operate under one of these three umbrellas.
True, true.
So even if you're doing a loan with a nonprofit, doesn't necessarily mean that it's free to you. There's still going to be costs involved. Uh,
Right.
so mortgage broker will generally, so in the state of California, mortgage broker will either be licensed through two different uh, entities within the state of California. One is the DRE, and the other is a CFP. And the DRE is what we're licensed under, which is a Department of Real Estate. So technically, I'm a mortgage broker, and the company is a corporate real estate company, and then Ricardo would be considered a salesperson. But we're operating under, our primary focus is loans, even though we can do real estate and a lot of other things.
True.
You really want to get into that, we can go into the weeds on all the other things we could do.
Right.
But we operate under what's called an NMLS license to do loans through the federal government. And that's covered under multiple branches of the government. We besides reporting to the DRE and NMLS, there are the CFPB and on and on and on and on and on. And then there's multiple agencies that everybody goes under. So like I said, you can, I'll back up. You're either going to pay an upfront borrower paid compensation, or it's gonna be paid through the lender
Now,
as a compensation. So what we're required to do is, with each lender, we're required to select our compensation with them upfront, so that it's hard coded into their system. So on average, I would say origination fees are from anywhere from 1.5 to 3% on conforming and FHA, VA, USDA. It's kind of the range. So we have ours at it's 1.75, right?
yeah, if I remember correctly.
So sorry, just want to make sure. That I would say the average most people are listing out at is 2% or higher.
Right.
But it's gotten more competitive, so maybe that number has dropped down, but the industry average was in between 1.75 and 2% for the longest time. But we're that way across the board with all of the lenders we operate with. And so it would be conventional, FHA, VA, USDA. We're the same across the board with all of those. With some of the non-QM stuff, we may be a little higher. We might be at 2 or 2.5, depending on the program and how difficult they are. If they're not, we just stick with the 1.75 across the board. But there are some programs out there that take a lot of work, and
Right.
and they have a higher risk also to us.
Definitely.
So we have it hard coded that our lender pay would be 1.75, and then that means that our borrower paid cannot go higher than that. So at any time, our borrower paid is at 1.752. So we can't charge you 2 points on borrower paid and go higher than what our locked in pricing is with the lender.
Right. I think it might be helpful if we expand on when you mentioned upfront versus lender paid. It doesn't mean that the homeowner or potential homeowner is paying us before the loan is completed. Upfront just means
Correct.
that it's part of their closing costs. When they go to the closing table, it's worked into the costs that they have to come up with to close the loan, right?
Yeah, so the difference is, and I wish I would have thought about that and printed out I could have saved a sheet so we could show you what the form looks like. But basically, on the closing disclosure, it's going to show as a borrower paid, it's going to be shown as a charge to the borrower at the closing table.
Right.
And then if it is lender paid, it's going to show as a charge to the lender to pay.
Right.
So it'll be on a separate line or column, column.
True.
So that's how we get paid, and we have to disclose ours regardless of how we operate. Okay. All the costs have to be disclosed from our side to you, regardless of where the money comes from.
Right.
Now a bank, and just so you know, price wise, everything in pricing in the industry, you're going to be within a quarter to a half a point in the same program. I would say even less than a quarter most times because everything's pretty tight. But you know, you can go as far out as a half a point on some programs just based on how different people price things. But for the most part, if you're looking at a conventional loan and the going rate is currently, you know, 3.25, which it's not, but let's just use that as a number, you're going to be a quarter point to either side is where you're going to get quotes. Then it gets down to, okay, and how is that structured? Is it borrower paid or is it lender paid?
Right.
And that you have to really pay attention and understand. So when you're matching up closing disclosures, you need to be, hold on a second, Ricardo, I'm going to open something up really fast so that I can maybe share it.
For sure.
It'll just be easier. I'm not sure it's going to let me do this. Maybe I'll just make a fake loan real fast. You see that, or I'm not asking you to share it. I'm just asking you.
No, I can't see.
That's good.
You'll have to
I
share.
don't really want to share it. I don't really want to share it. This is all back end junk. Nothing important, but let's see if I can get to where I can actually, if it'll let this.
Yeah, while you're bringing that up, I'll just expand a little bit on the broker side. So when you're working with a mortgage broker, which is what Rob and I represent, you're not locked into one set guideline like you are when you possibly go to a direct lender or possibly go to a retail bank. A lot of clients, you know, have the best intentions to want to go shop multiple places. The best way to do that is to find a trusted mortgage broker that's experienced or has the experience level that you think can handle your case, so that they can go to the, you know, the selection of lenders that they've funded loans with. A lot of times the broker will have a good idea just in communicating with you. Hey, you know, depending on the complexity of your loan scenario, maybe there's a better lender to go to versus another, because it's not just about a super low rate necessarily, but it's about a loan that you can close quickly on time and have a good service level to the client as well. And brokers tend to, rather than just look at a specific loan scenario through one particular lender's guidelines, they're looking at it through multiple lenders' guidelines. So it gets you a lot better result, you know, potential, a more customized loan to fit that your particular mortgage needs. So when you walk into a single retail location, a retail bank like a Bank of America or Wells Fargo, you're only allowing their mortgage people to look at it for their bank's guidelines, and that's it. So if you end up not meeting that lender's guidelines, well, you might get a denial letter or, you know, a really long process to try to, you know, fit into their guidelines by correcting certain things in credit or what have you. So that's why working with a broker gets you a little bit more flexibility and, you know, a better match to what on the loan program you're looking for. So do you have that up for us, Rob?
No, I'm not going to. It's not one bit.
Okay.
It's taking me too long to get it. I've got to get it to the point, and I apologize. I should have thought about that. Rookie mistake on the second podcast.
No problem. We're
I
working
should have
things
thought
out,
about
man.
that before and
We're
built the
working
loan
things
in
out,
there in a
brother.
second. Yeah,
It's
exactly.
no worries. Like we say in the text below.
We'll cover those forms. We'll cover closing disclosure and another thing. So I won't get into the weeds on that as much.
Right.
Maybe we'll do that on the next one. But so a mortgage broker is basically somebody who brokers loans back and forth.
Right.
A bank, a retail bank, is an easy one. That's like a Wells Fargo, brick and mortar, Bank of America, Farmers and whatever, merchants, credit
Chase.
union, all that kind of stuff. They're going to be generally FDIC banks, and they're going to have their own product,
Right.
which is really not their own product. What they'll do is they will use their funds to fund the loan, and they may or may not retain the servicing rights to it. So they will, all the paperwork will be on there as their loan. So if we do a loan with you, it's going to be, we're going to be listed as a mortgage broker, and then the lender that we place the loan with will be listed on there. So ABC Lending. Whereas with Wells Fargo, or Bank of America, whoever, it's just going to be their name, retail bank, and all their documents will show that way 99% of the time with them.
Sure.
They will primarily only do conventional VA, FHA, maybe USDA, depending on what part of the country they're in.
Sure.
And then they may have their own in-house stuff, which is for their top clients. So every once in a while, somebody will come to me and they'll say, hey, I need a loan. I'm doing this loan and I'm getting quoted, half a point through Wells Fargo or B of A. Well, that's not really a mortgage they're getting. They're getting that based off of the millions of dollars that they have invested at that bank or their deposits. And what they're basically doing is they're giving them a margin account. I mean, ultimately, that's what it is, because if it's tied to cash, then they'll go dollar for dollar. But if it's in bonds and CDs, maybe they'll only give you 70 cents on the dollar for what you have in there. And if it's on stocks, it could be, 30, 40, 50% of the value of those stocks. And just like a margin account for a stock broker account, if your stocks that you put up to cover that drop down, they could technically do a margin call and say, hey, your stocks are not worth as much. You either need to put some cash in the bank here, or you need to pay your loan down. So I know those are out there, and a lot of people in the multi-million-dollar homes use those a lot. So that's kind of what you'll see. A guy like Elon Musk and whatever Amazon boy, what's his name? Drew blank.
Bezos.
That get their money. They don't actually sell their stock off and pay a capital gain. What they do is they take loans out against their shares, and they're not worried about it because they know that they've got plenty of shares to cover it if they ever have to pay it off. So the bank, another thing with retail bank generally is they will have tighter lending conditions. So depending on the market, they may only want 720 and above borrowers.
Right.
Then if the political winds change and they start getting pushback from the government that you need to take more poor quality loans, and they're given an incentive by the government to do, which has happened in the past, then they go and they will lower the standard, and they'll go down into those low end credit scores all the way down into the 500s, and sometimes no credit score at all. If they have the incentives from the government to back them. In other words, they don't want to be left out to dry on those. So those lower performing loans they will do with some extra incentive through the federal government. Sometimes it's part of a mandate that they just have to do it and they have to do so many. So they're out there begging people to do loans that they know that they probably shouldn't even be in. But
Right.
it's another topic. And that's everybody gets involved in that. Sometimes you do loans, at a certain point, who's the responsible party? I can tell somebody this isn't a good thing for you, but if you're headstrong and you want to move forward, you're an adult. I'm not going to stop you from getting a loan. I will make sure that I tell you verbally and in writing that I think you're making a mistake. But at the end of the day, you're the adult. You're signing the paperwork. You're putting your name on it. Um, you know,
Right.
it's on you. So that's a bank. The bank generally isn't going to go out and go into the non-QM realm,
What do you mean by
which is
non-QM? Can you just,
yeah, you just you
you're
beat me
throwing
to it.
out some terms that probably
Right.
our viewers don't
So
know yet.
so a QM loan, a qualified mortgage, is generally a 30-year fix with certain parameters, very conservative loans. It can also be some other loans, but for the most part, it's think 30-year fix, 15, 20, fixed
Sure.
rate. It's not going to adjust. You have really good credit, all that. Non-QM is non-qualified, and it gets into adjustable rates, prepayment penalties, shorter terms, um, higher closing costs, uh, and it's a riskier loan. It's not a full doc. A lot of times it's not full doc. There's a whole bunch of other programs out there, and we'll go into those in a future video. But it gets into the weeds on those programs. Rates are generally higher, but if you do the math and it pencils out, sometimes it makes sense. If you're buying investment properties where you really need the loan and it's for short term. So then you have what's called a direct lender. And a direct lender is that in between a retail bank and a broker. And what they have is what's called a warehouse line. So they have a line of credit depending on their size. And there's different types of lenders. There are some lenders that are, so Wells Fargo operates off of warehouse lines too. FDIC banks operate off of warehouse lines, but they also have their own client money too.
Right.
Whereas a direct lender will not be generally using their own money unless, and even then it's really not theirs, unless there may be a non-QM lender that's doing some specific financing, which I don't want to really delve into too deeply here today. But let's just say there are some direct lenders that have their own cash that are actually lending their own money, or they have investors behind them that have said, this is the type of property, this is the type of loans I'm willing to do. I'm willing to take this type of risk at this loan to value. And then that there's no warehouse line for that. They just fund direct through they're kind of the front for an investment pool to fund off of. But generally, direct lenders are operating off of warehouse lines. So with regards to that, there's, for lack of a better term, there's kind of three. One of them isn't really around much anymore. But so there's a beginner warehouse line, which is somebody who's taking the step from broker to move to lender. And they may only be able to use that line of credit with one specific or two specific wholesale lenders out there. And it's all pre-arranged and pre-underwritten, and that lender does all the underwriting for them. They don't do any. It's like a beginner's warehouse line. And then you get into the in-between, which is it's from that point on, it kind of is the same thing, but there's two different types. There's one where you can keep it kind of on your books for 30 days, might be a little longer. I'm sorry, I haven't been involved in it for a couple of years, so a lot of the stuff has probably changed, but basically they keep it on their books for 30, 60, or 90 days max. And then they have to get it off their books and sell it.
You
And if
mean the
not, then
loan
they
when
charge you money.
when they fund the loan, they keep it and
Right.
service it
So
for
once they
the
fund the
first 3
loan,
months?
right. And here's the other
Gotcha.
advantage to that over a broker. Once you move to being that, then you fund in your name. So you can run around and tell everybody it's our money, we do what we want. When ultimately it's nobody's money. It's, you know, some
Right.
huge investment that's backing everybody, probably BlackRock or something like that.
True.
Or Freddie Fannie is buying them off this. And so you get your warehouse line. It's based off of your financials, and maybe you're given 3 million, 5 million, 30 million, which means you can fund up to that number and have that number on your books. And once you hit the top of whatever your credit line is, you have to sell loans off before you can fund loans. So that's where you'll run into delays in loans a lot of times, where a lender will be at the top end of their credit line and they can't really fund any more loans because they need to sell.
Right.
And you'll see changes in pricing. So they can control their own pricing. And if they want to, can you hear that? That's a freaking cat in the background yelling. So they'll control their pricing a lot of times to push away customers when they don't have a lot of credit line. But then once the credit line opens up, they'll get more competitive to bring in deals.
Gotcha.
So that is one thing you have to be understanding of what goes on with lenders in general is even the big ones will adjust their pricing based off of what's going on with the money they have to fund.
Right.
And this comes from experience in the wholesale industry, which we kind of talked about in my past. But the advantage to the direct lender is they no longer have to disclose their fees to you in the same manner, because they're technically selling those loans to the secondary market in the transaction. So once they fund it, then they sell it to whoever. And that's where a lot of times you'll see the loan was funded with ABC lender, direct lender, and then 30 days later, your loan is sold. Or not even 30 days, maybe 5 days after it's funded, it's sold.
Right.
And you're already receiving notification that it was sold to Freddie and Fannie, and then the servicing rights were sold to, this other lender or service. And then, which is generally the one that they were. So like if we were doing a loan with you, and let's say we're using United Wholesale Mortgage, which is a very large wholesale lender, which a lot of people in the industry use. They're the number, at least the last time I checked, they're the number one lender. They go back and forth with Rocket or whatever their current name is this week.
Sure.
So let's say I do a loan with you and I fund it through United Wholesale Mortgage. It's going to show Prominent Lending Group as the broker, United Wholesale Mortgage is the lender, and that's the way it's going to go. And then generally, since UWM is a very large company and they also do the servicing, they will maintain your loan and keep your loan, and it won't be sold off for, depending on the program, it could be 2 or 3 years. Or if something comes up, sometimes they'll sell it like 6 to 12 months down the road, max. But generally what they'll do is they'll offload it. They'll sell the loan to Freddie and Fannie or FHA or whoever. They'll sell the loan off, but they'll maintain the servicing rights to it. So if it's a Freddie Fannie loan that's back, Freddie and Fannie will buy it, and they'll keep it, but they'll have somebody else service it. Follow me?
Yeah.
And if you're a direct lender, so if I'm a direct lender, I'm a newbie direct lender, maybe I have a relationship with UWM, and I fund the loan as Prominent Lending Group. So there's no broker anymore. Now it's just me, Prominent Lending Group. If I'm acting as a broker, I mean, as a lender. Sorry, just had brain fog. So if I fund it under, let's say Prominent Lending Group is a lender, acting as a lender, I fund it onto my warehouse line. Then I'm going to sell it. Well, as a beginner, I'm probably going to sell it within 3 to 5 days of funding it to, let's say, UWM. Then, so you're going to get a notice that I've sold the loan 3 or 4 days, 5 days, 15 days later to UWM. And then UWM's going to take it and they're going to start the servicing on it. So you're going to have to make your first payment to them, right? And then also you're going to get notification within probably the first 30 to 40 days that the loan has been sold to Freddie and Fannie, but UWM will maintain the servicing rights and you're going to make your payment to them.
Right.
Right. So that's kind of like a beginner direct lender. Now you get to a more advanced one that maybe is able to hold things for up to a year on their line or multiple months, and they're okay with it because the haircut or the cost of the line of credit is being covered by your interest payment. So they're making money. So maybe they're paying a point or two on the money they're borrowing on their wholesale line to loan it to you at 5, 6, 3, 4, 5%. So it makes sense. They're making 2 or 3% while they're holding that loan from you in daily interest. So on that type of a person who's been a little more experienced, maybe they even have their own funders at this, maybe they have their own underwriters and account managers and processors and funders and everything. Maybe they're not using a United Wholesale Mortgage to close the deal and just put it in my name and sell it. Maybe they have all of this, the back end to it, and they want to hold it for a month or two. But those type of guys, then you'll get a notice between 30 and 6 months, 30 days and 6 months that your loan is being sold. So they take the first couple of months and they make some money on the loan, really extra money on the loan, the interest you're paying. So you're making the payment to them directly. So in those type of situations, you sign your paperwork, and your first payment you make to them, and maybe you make your second payment to them, and then they sell the loan. And they get, so on top of the fees they charge, they are also collecting on the daily interest. And then they sell that loan off to somebody else. And then from that point, then you're going to get a notification that it was sold to Freddie and Fannie, and this company is going to be your new servicer, and you have X number of days to make payment. And if you're late, you're not going to get a late fee, all that, you know, the usual letters that go out if you've had a mortgage in the past.
Right.
And then you get the larger direct lenders that are maybe real direct lenders in the sense that it is really their money, or they have investors behind them and they're doing not traditional. They could still do traditional, but they're not focused on Freddie, Fannie, FHA, VA, USDA. They have their own niche. All right. They have their own product. So they've gone out to either a BlackRock type company, a smaller one that wanted to get into the mortgage industry. Well, I have a friend who went through this. They came in and they wanted a piece of his company, and they wanted him to sell their product. And they brought him a product and they price it out, and they do it. Or they work with a bunch of dentists or doctors that have all this money and have made a little group, and they all put their money in there, and they like a real estate trust maybe, and they're lending out of a real estate trust where they have investors that come in and they do these loans, and the performance of those loans goes back to the people in the REIT. So that's another way that you could be a direct lender. So advantage of being a direct lender over a mortgage broker like us is you're not required to show your back end or your secondary funds. So when you sell that loan, if you make 2 or 3% on the back end, you don't have to disclose that. You don't have to disclose what you're charging the borrower. So like me, I have to show you, if it's borrower paid, I have to show you my full payment, right? So if you're paying me 1.75, and let's just make the assumption that it's $5,000, I have to disclose that. All right.
Right.
Regardless, or if it's 10 grand or 15 grand or 20 grand. A direct lender can chop that up. So what they could do is, what I can't do, they can charge you a portion of it up front and take a little bit in raising the rate. Follow me?
Yep.
Now, technically, there is a way to do that on my side, but it gets real dirty. So it's where you have the lender do all the lending. You do a lender paid, and then you have a buy down. You know, I would only do that if it was because I couldn't get the whole lender paid done because of rate caps. But with a direct lender, I could tell you, well, my origination is $875, a $500 origination, $1,500 origination, $1,000 origination, $2,500, and then the rest could be built into the back end as a higher rate. This is where you'll hear a lot of advertisement that says no cost loan, and this stuff I think is kind of finally getting beaten out of the industry because the regulators are finally catching on to it, and I mean, I've always considered it false advertising. So, you know, if I tell you that I'm giving you a no cost loan, but it's lender paid, so I'm not charging you origination, right?
Right.
That's what they consider a no cost loan. Well, no origination fee.
Well, it's not
still have
really
all
no
your other-
cost to your point. It's worked
Right,
into the
there's
interest
still
rate.
title,
The cost is in the
escrows,
interest rate.
blah, 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 blah. Right.
Right.
So with direct lenders, that was the big advantage of being a direct lender, that you could say, oh, well, I'm not charging you origination fee. Look, your rate is 5.75 and you have no origination. That line is blank.
Right.
So with me, 5.75 would be a lender paid loan then. But you would see that I'm making X dollars. So if I'm making $10,000, it's going to show that the lender is paying me $10,000 for your 5.75 interest rate.
Right.
But the direct lender isn't going to show you that. On there, it's going to be cleaner, for lack of a better word. And they're not going to have to show that. The other thing is they can massage it around a little bit better if you're rate specific. So if you come to me and let's say a lender paid par rate, par means zero costs to you. All right, there's still costs, but zero out of pocket cost to you is par, zero. So 5.75 is that. If 5 1/4 is a point, then a direct lender could come to you and say, well, if you want to buy your rate down from 5.75 to 5 1/4, it's going to cost you 2 points. So a point for every quarter, basically.
Yeah.
Is what they may tell you. And then you're going to go, oh yeah, that's great, I want that. Whereas for me, it might be instead of 2 points, it might be actually you get credit back because I'm at 1.75. So I go down 1.75 and maybe the rate at 1.75 is 5.375, and you want that extra quarter, then, or that extra 8, then there may be a minor hit to buy it down an additional 8. Follow me? Are you following me, Ricardo? Because if you're not following me, nobody's following me. Which you probably aren't anyhow, to be honest. This is really in the weeds.
Yeah, but
So
I thought we were going to have the landscapers join us in a minute.
yeah, exactly. They need to come in fast with the weed whacker. So so just realize that there's a lot more flexibility on how they do the deal. A lot of places will place their origination fee as what they're paying their loan officer. So it could be $250, it could be $850. So a lot of times there's a mentality that they just, some banks have the mentality that they disclose whatever the commission is they pay the loan officer. That's another thing I've seen some places do. So you'll always see like a weird number in there, and that's what their current commission is to the loan officer.
Right.
Um, and so that's the 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 direct lender. Now, a direct lender can also operate as a broker. So you could do both. You could be a direct lender or the broker. So maybe you're just focused on FHA as a direct lender, but your warehouse line isn't structured to handle conventional. So what you would do is you do all your direct lending through your FHA account, and then you'd push out your VA, your USDA, and your conventional, your Freddie Fannie, as a broker, because your main focus is everything you advertise, everything you do is FHA. But when you have those customers come in and um, another program is better for them under those circumstances, you don't want to lose the loan. So yeah, you switch them over to that program and you broker it, and then they would move it off to a whole. It may even be the same company they sell their FHA to, but they sell it to they, instead of selling it to them, they broker it to them.
Right.
Follow me? So those are the three types. If I missed anything, I mean, there's a lot more you can get into in it, but basically that's the difference in the industry. There's basically three groups.
Right.
So if we want to step on that fourth thing, we can talk about it. Or did you have any questions or see anything I missed covering the top three?
No, it really comes down to, just pairing up with, finding the right experience um, individual, whichever, if it's mortgage broker or direct lender or banker.
Yeah,
Right.
I don't want to say one is better. So here's the thing. You will find great people in all areas.
Right.
All right. The difference is what their background is. So you'll find somebody that works for Wells or a retail bank, and they're Johnny on the spot and they get everything done. They've been doing it for years and they're happy in their situation there with that bank. They're maybe limited, and I know this because I get a lot of referrals through contacts at certain banks where they have somebody that they can't do the loan because it doesn't fit um, their guidelines. So, okay, let's talk overlays really fast to explain this. So, Freddie, Fannie, FHA, USDA have their guidelines. Then lenders that lend on that, wholesale lenders, or the people that buy the loans, have overlays where they say, we don't want anything under 620 for FHA, 620 FICO score, even though you don't even need a FICO score to go FHA. It's really hard to get there. So don't think that if you've got no credit score, you're going to get a loan. You better be one of these people that has tons of cash and be able to show that you have a history of credit that doesn't report to credit bureaus. But that's an overlay. So if I say, well, I don't want any loans under 620 and I don't want any debt to income ratio, DTIs, above 45%, let's say. I don't want to do the 50 plus, or 45 plus range. And then they may also say, oh, I don't want to do mobile homes or mobile
Right.
homes. I don't want to do condos. I mean, I'm just throwing out different things they could say. There's tons of different things.
Right.
They
So
could
overlay meaning
could-
it's an extra guideline that
Right, it's their own personal
Right.
guideline that they're putting down. That's why you'll see somebody go to one direct lender or one bank and they can't get a loan and they're frustrated.
Right.
I don't understand it. Why can't I get this loan? It's more than likely that they have an overlay that is what's affecting it. All
Right.
right. And then if you end up going to a more experienced person, and here's the thing, you can be with an experienced person and a lender who will say, you know what, I can't do this loan because it's not, we don't have a taste for it, right?
Right.
But I have a friend I can refer you to. Call this guy over here, right? That's what they might say. Um, or if they can do it and they know how to finagle it through their system, then they will finagle it through the system. I'm not talking fraud. Nobody's doing fraud. Trust me. Nobody here is looking to steal hubcaps and do something for you that's dishonest. It is way too hard to get and keep a license, and the penalties that go on with playing games are not worth it. Everybody involved can get jail time. Everybody involved gets fined, and the fines generally start out at $10,000. And that's on both sides. That's you, the client, us, and everybody else that's involved. If they've had any, if they've played any, I was going to use another term, effery. Um, if they play any games, and the thing with fraud, we might as well have this quick conversation here, is they're not going to go after you and charge you with mortgage fraud. Well, they might, but 9 times out of 10, what they're going to charge you with is wire fraud, mail fraud.
Right.
What's the other? There's like 3 or 4 different things that they charge you with. Why? Because the what is required to prove it is so much simpler than mortgage fraud. So then you're going to get hit with 4 or 5 things and maybe even mortgage fraud. And then once you've got that conviction on your record, you're done. Forget about getting a job in any financial institution. Anybody that deals with money is not going to want to hire you if you have had some kind of a financial crime. Sure, you may not do jail time. You might get off lucky with probation, but forget about it. Oh,
Right.
and try to get a license. So now you're a supposedly we're professionals because we have a license.
Right.
But let's say you want to go and get licensed in something else. Every year that I get licensed and have to renew my license, I have to disclose, have I had any other licenses, professional licenses, revoked ever? So I'm assuming that's the same for if you want to be a CPA, if you want to go be a beautician, all these different things that require licenses, contractor's license.
Right.
You got to go and, disclose that you've got a financial crime. Don't play games, folks. It's not worth it. It really isn't. I've seen a lot of them, shook my head a lot of them. I've had to turn people in for it. And some of them were I'd become friends with when I was in the wholesale game, and I catch somebody doing something. I'm like, I have an obligation, get ready. It's coming. But kind of went off on a tangent there. Where were we before that, Ricardo?
Yeah. Well, you had just, talked about the funding. Where were we?
Yeah. Yeah.
You got
Well,
me
once
into
you
the
get
weeds there.
it gets serious, and it's just something you don't want to play games with.
Yeah. Basically, fraud never pays. It's not good
Right.
to, try to create fraudulent proofs of income or documentation to try to look like you
Right.
are going to meet the criterias.
Oh, I know where it started. So we had started talking about choosing somebody to work with.
True.
Find somebody you trust, regardless of who it is, but still hold their feet to the fire. Don't be afraid to confront them. When I started out in what you'd kind of call a boiler room, where you sit in a call center and you take calls and sell loans, and they would put anybody in there with a pulse, And some of the things I heard people saying were just cringeworthy, and I was new to the industry. Then I went into wholesale and I saw a lot more things. And remember, ultimately, we're salespeople and we're selling something, but we're also selling a service. That's the way I look at it. I'm not really selling a product, I'm selling a service. I don't really care what loan you get into as long as it's the right loan for you. I get paid the same. That's why I've chosen to go across the board with all my lenders, the same comp plan by company for the company. Ricardo, we don't get all the money when we close a loan. The company gets a portion of it because the company has costs, you know,
Right.
office space, software, multiple, you know, insurance, all that kind of stuff. So other people on both the broker and the direct lender side, and I would also assume the bank side, even though I've never actually worked in a brick and mortar bank, they all kind of operate the same. They can, some people will do like, oh, well, with this vendor, we're going to go 1.5. And with this one, we're going to go 1.75. And this one, we're going to go 2%. And with this one, we're going to go 2.25. And this is where I'm not sure if it's technically considered steering under federal guidelines. I consider it steering. So if I take you and I go, oh, well, you're not a real savvy person and you don't know a lot and you're really hard up and you need this and you haven't been able to get a loan anywhere, but I can get it done and I'm going to send it over here to 2.25 because I'm going to make 2.25 on it. But I've got somebody else who's more competitive. Maybe they're A paper, and you know that they can kind of. Okay, first, just because you have A paper, your A paper doesn't mean you can just go anywhere, you know. But you can almost go anywhere, and maybe they'll go out at 1.5 or 1.75. See what I mean? So they will, within their own stuff, they will rate shop you to what's best for them. I don't do that. All of my lenders are the same.
I mean, the
believe that's starting to
compensation
change
that
in days.
that other brick and mortar banks you're talking about?
I'm talking about through all of my wholesale lenders that I use.
Right, but I was referring to the scenario you're posing that brick and mortar banks can shop
Well, I've
you.
seen brokers. I've seen brokers play this game. I've seen direct lenders play this game. I can't speak for brick and mortars because generally they're a little more structured in how they do things.
Okay.
But I could explain how they kind of do things in a different way than this. So they don't, because a broker can't really change his thing.
Changes compensation. The thing means compensation, right?
Yeah. They're not supposed. They're supposed to set their compensation. It's like when you go to a lawyer or you go to a doctor. They're supposed to have their their fees on the wall. Not really, but you know what I mean. They disclose their costs, right? They say, hey, we're $350 an hour, right?
Sure.
Well, that's what we're supposed to do as professionals. So I disclose all that stuff up front. I'm not embarrassed by it. If somebody wants to argue with me about my fees,
here's the bottom line.
I can justify them.
Every business has operational costs,
Right.
And it's not like we're swimming in loan applicants where we have thousands and thousands of loan applicants that are funding every month.
That's regardless. You still have you can't use the quantity. The quantity thing doesn't matter. It doesn't matter if you're doing one loan or 1,000 loans a month. The costs are the costs.
Right. It takes time.
If anything, it's harder for the guy doing less, but he can't. If he was only doing 1 or 2 loans a month, he's going to need to charge 2 or 3%, 4% to make it, which he's out of the market and he's dead. All right.
He's pricing himself out of the market is what you're saying.
Right.
Yeah.
Right. And in a larger place, so well, I'll pick it up on volume. That's not the case. Those larger places, you've seen their ads. They're running ads over and over again on the radio or on television. That is not cheap marketing.
Exactly.
That is buying name brand.
Right.
So when you see companies doing advertising on the radio and on this, those costs have to come from somewhere. They come from those closed loans.
That's right.
So realize that. I try to operate off of referral mostly. I try to keep my marketing costs to be low because one, I found a lot of it's a waste of money, to be quite honest. I would much rather have a referrals from somebody who's done business with me and then sends a loan to me because they know I'm going to take care of them.
Right.
Whereas those companies that are doing all that marketing, they are not doing 1.75. They're doing 2 and an eighth, 2 and a quarter, 2.375s, where there, because they have a lot of operating costs. And it's not just that loan officer, it's their whole underwriting division, because they're more of the top end of the direct lender. So they have all these costs to operate and close the loan. Then they have post-closing on top of that. So they have a team that sells the loans.
Right.
So there's a lot of costs involved in that. So just because they're doing 1,000 loans a month doesn't mean that their pricing can be below everybody else. They might be able to buy market share for a little while, but that's not going to last for long.
Right. Yeah, and that was my point, is that whether you're doing a small amount of loans or a large amount of loans, there's still going to be costs in them. It doesn't mean that you're going to cut out the loan agent or the underwriter or the funder or the secondary market or people that are set up to service the loan. It just means there's more workforce and more risk, which means more insurance, or, however they're balancing that risk out with, their financial backings and what have you. So those are all costs that are more massive, even as you get more fundings in the thousands or tens of thousands or millions of loans that you're doing, in a short period of time. Your operational costs are just massive on that. So, yeah, it ultimately depends, if you found the right individual to work with, you connect with them in a way where they're not treating you as just a number. They're actually wanting to really help you, and it's that genuine, heartfelt help that, I tend to gravitate towards when I'm doing business in pretty much anything these days, with exception to like maybe I don't know, going on a store shopping, for food or what have you. But any major purchases, it's really done with people that have a connection. I have a connection with them, and I feel they're going to service me, give me great service to earn the right to do business, for them to do, or my business. So yeah.
So back to what you should look for. You should look. One, I would definitely go to NMLS, and if you just search NMLS license lookup, then you can punch in the person's NMLS number. We're trying to disclose it, and you can look and see, one, where they're licensed. Two, you can see if they've had any
disciplinary actions.
Disciplinary. Thank you. I was drawing a blank. It's criminal, but if you're criminal, you're not going to be licensed.
Right.
The second thing I would say is to generally on our advertisement, we also show our state license and who we report to with the state, because every state is different. California has 2 different agencies. Other states have 1 or their own. So if you're, I've been licensed in multiple states, and then you got to go to that state and you want to look up their license on that state to make sure there's not stuff. So if you go to the Department of Real Estate, you can look up and you can see if the license has ever been suspended, or if there's been disciplinary information or disciplinary action on both the company and the individual employee. So if you go to if you look up Prominent Lending Group, it'll show Prominent Lending Group, and then it'll have places to click through to get to my name, Ricardo's name, and anybody else that's worked with us or works with us in the future. And that's a good thing to look at, because I'll tell you, you get in there and you look at some of these guys' licenses, they've had a lot of disciplinary action, but nothing major, in the sense of, the big no-no with the DRE is escrow accounts. So if you do any game playing with other people's money and you have a violation, that can get you your license lost and suspended. And then there's a whole bunch of other things: not paying your child support, not, get a DUI, your license gets suspended.
Right.
Not pay your child support, boom, license suspended. And then there's just regulatory stuff too, where they can fine you for things you did wrong. And I wouldn't say that that's a bad thing. A lot of companies get inspected from time to time. And when the regulatory agency comes in, they might find things you think you're doing right, but there was a law change, or they don't like the way you're doing it. There's a lot, like in all business, there's wishy-washy. Oh, well, you're filling out this form incorrectly. No, I've done the training, and this is the way, I've been to training, and it was said to be this way. No, well, we changed 3 years ago. We don't like the way that it is. We don't do that. And it never got out in a bulletin or whatever. Or it could just be that one inspector's personal, thing that they just have a thing with. And the next thing you know, now you've got a mark on your record. So I would ask the person what the reasoning is behind it. So I had a guy who wanted to come work for me a while back, and he had a problem on his license at the time. And I was like, hey, what's going on here? And what it was he had done a real estate transaction. He was a broker too, and he had done a real estate transaction, and one of his realtors had taken an upfront fee. Well, the deal fell apart, and they were required to pay it back, and they didn't pay it back. And I'm like, why did you ever let it get to where the DRE had to get involved to get you to give them the money? Why didn't you just, as soon as you find out about it, write them a check and give them their money back as a broker, regardless,
Right.
and then deal with your real estate agent, salesperson. And he's like, well, I never really found out about it until it's too late. I'm not buying that, but yeah. So it got all the way to DRE, and he got suspended. And I'm like, well, how do you expect to come to work for me with a suspended license? He goes, well, I was hoping you co-broker it and pay me off the side. I'm like, no, you're not licensed. I'm not going to do the deal and then pay you.
Right.
So yeah, just do some research into people. I mean, you can look at ours; they're clean, so I'm not too worried about that. But and get a feel. It's kind of hard. We're not, because of all the rules we're under. It's not like we can tell you about somebody we've done a loan with, because that's one disadvantage in this business. I cannot go and say, this person. I can give you generalities to deals I've done. I can talk about generalities, but I can't talk about someone's loan, because they have privacy. And that even goes to reviews. So, if somebody gives you a bad review, you can't go on there and defend yourself. It's impossible, because you can't talk about the loan. The privilege is not with us. It's like a lawyer. You have, what is that called with a lawyer? Confidentiality.
Yeah.
It's something,
Attorney-client
I can't think of the term.
privilege.
Yeah, client privilege, attorney-client privilege. It's not called that in our industry, but basically we have the same thing. We can't talk about you regardless. So, I have people that'll come to me and they'll say, well, gosh, all my friends are getting loans at, 1%, and I'm getting this loan at 4%. I tell them, I said, you can tell them whatever you want. I don't care. I'm not going to come. If I was at a you know, at a party with you and you're telling everybody that you got a 2% interest rate from me, and I'm just gonna sit there and have a deadpan look on my face, kind of like how I do now. Um, and I'm not gonna say neither way what you had. And even if they talk to me, you know, I've done loans for family members, and other family members come with me and say, "Oh, I hear you're doing a loan for them," and I go, "No, they never got a hold of me. I just play dumb and move on. It's none of their business what I'm doing. I don't discuss my business with people. Um, Loans that I've done with people, even referrals. Somebody refers a loan to me, I don't go back to that person and tell them about the loan. I thank them for the referral, and that's it. You know,
Right.
that's the most they're gonna get is a thank you, and I do appreciate it, and it's heartfelt. But I'm not gonna get into the details on it. And even if they call me and say, "Hey, you know, my friend called me," and I'm gonna say, "I can't talk to you unless that borrower, that person that I'm working with, in writing gives me authorization to talk to that person, I can't do it." So realize that. But yes, do your research. Don't be afraid. And I don't have a problem if you want to shop me. The only thing I ask you to consider is this: if I put together a loan for you and you've been to 3 other people and they couldn't do it, and I put the whole loan together, and then you go and take it to somebody else and show them, basically take my blueprint to them,
Right.
and they say, "Yeah, I can beat it by X." They're not doing any of the work. They're stealing the deal and undercutting it.
Right.
And I would hope that you not do that. But I also understand it happens, and I'll bite my tongue and move on to the next person that hopefully appreciates the knowledge that I've gained over this unfortunate 20+ years in the industry. I'm kidding, not unfortunate, but and and I've had that happen. I've had loans come to me where people couldn't get their loan done, and I figured it all out for them, and then they walked and
Right. I
went
mean,
to somebody else.
that's even worth, going deeper on, because I think I've had, I've been one of those types as
But
well to figure out.
that's in any business. It's a percentage of the
Right.
business. I don't want to sit here and cry about it.
No,
I
I'm just saying, because
I'm
it
just
does
saying,
take that
please
time to figure it out.
appreciate my knowledge and do it.
Right.
That's
We would
I
ask
don't really
that
want to stay
you
on.
appreciate the time we've invested and, close the loan with us.
Right.
It's a respect thing, If I'm
Well,
going to do business
I
with
also
somebody.
understand if I'm way off on pricing, I'm not gonna, I'm not gonna. I don't think I am, but if I'll give you a scenario. I had a gentleman years ago that I quoted him a price, and it was market. It was what the market is. It's conforming. There's, you know, you're pennies away from everybody. It's really nominal difference. And I don't remember the rate I quoted him. Let's say it was 4%. And he kept saying, "No, I'm getting quoted 2.75 or 3%." And I told him, I said, "Listen, that is not a 30-year fixed rate. Make sure you look at the paper. They're quoting you a 5-year arm, probably with a prepay. Because back then, conforming could have prepays."
Mm-hmm.
And he says, "No, they guarantee me it's a 30-year fix." I go, "Well, then if that's I can't give you that rate. So obviously, if that's truly a 30-year fix, then you gotta go. But I'm telling you, it's not." So 3 months later, 4 months later, he calls me and he's upset, and he goes, "Hey, Rob, I just called you so you could tell me you told me so." And I'm like, "What are you talking about?" He goes, "Do you remember?" I go, "Yeah, I remember you, but I don't know what you mean by tell you I told you so." He goes, "Well, you told me that the rate they were quoting me was a 5-year arm. Um, and guess what? It was. I don't want to be in this thing. I want you to refinance me out of it and all of that." And I go, "Well, first of all, I'm not going to sit here and gloat and tell you I told you so. I'm sorry that it happened to you. I'm upset,
Yeah.
that somebody screwed you." And I said, "Well, before we go and refinance this thing, since you're in such a great rate that's fixed for the next 5 years, let's make sure you don't have a prepayment penalty. And he says to me, they told me there's no prepayment penalty on it. So I came back and I said, they also told you that it was a 30-year fix. Call the lender, not the broker that you did or the lender you did. Call the servicing company. So now he's with the servicing company. He's no longer dealing with a salesperson, loan officer. Now he's dealing with the servicing company. Is it call the servicing company and ask them if there's a prepayment penalty? And if there is, ask them what it is. Called me back 10 minutes later crying because he had a prepayment penalty and it was going to be like $60,000.
Wow.
And he's like, what am I going to do? I haven't even told my wife yet. He goes, she's going to kill me. And I said, don't panic. This is not the time to panic. It's not the end of the world. You can take advantage of this loan while you can. I go, you're getting, 2 or 3%, whatever it was. And yeah, you have a pre-penalty, but you know when that ends. It ends in 3 years. So what you're going to want to do is, in 3 years, hopefully you'll remember me and you'll call me. But if you don't, you're not going to hurt my feelings. In 3 years, you're going to refinance out of that thing if rates are still higher or the same. If not, you're going to stay in it the whole 5 years until rates adjust accordingly and take advantage of it.
Right.
Well, he actually lucked out because 2008 came around and the world crashed, as everybody knows, or at least they thought it had crashed, and rates tumbled, and his adjustable rate loan during a period was actually adjusting down even. So he was actually, it was worth it to stay in it as long as he possibly could. Even when it adjusted, he didn't adjust up like would normally happen on an adjustable rate. He stayed low and he got to take advantage of it. And then he probably, I had long left that company and gone into wholesale by this time, but he more than likely was able to refinance into some very low 30-year fixed rates after the crash. So he actually came out smelling like a rose on that. Didn't have to take the hit for the prepayment penalty. But I sat there and talked to him for a while. I explained to him, I said, if you need to, you can have get your wife on the phone. We can talk about it and I can explain what strategy you should take at this point. And move forward. Like I said, I never heard from him again. But I'm sure it all worked out for him because the crash is what really saved him,
Right.
And then rates stayed artificially low for years, so I'm sure he came out smelling like a rose. But those are the things. You don't trust what anybody tells you. Double check it by the documents that are presented to you. It's really easy for me to disclose all my disclosures to you and show you everything that I'm paying, and you show it to somebody else and they say, yes, I can beat it. Make them disclose and make sure everything is disclosed. And this, so this is this we'll get into with disclosures of costs, but never accept, those fees change. What I always do is I always over disclose. So if I know a fee is generally $150, but it can be as high as $250 at the beginning of the loan, I'm going to disclose $250.
Right.
But I'm going to explain that to you. I'm going to say, this is high. This is as high as it can get, but it's probably going to be here based on X, Y, and Z. And the reason that is that under certain circumstances, it will be that. 10% of the time it could be that higher one. But I have to disclose it that way so that I don't get bit later on. Because if I just disclose $150 and it turns out to be $250 and we're over our tolerances, which are very small, then I have to come out of pocket. So I want to make sure that I'm disclosing. I don't want to over disclose to where things look crazy, but I do want to disclose. So like if I know that an appraisal, you know, is possibly going to be X, but it can be down here, I'm gonna disclose the plays are at the high cost until we order it. Then once we order it, we'll know what the actual cost is. So on those things that are outside of my control, with third parties, I'm gonna go with the higher cost, knowing that that'll adjust down, which also helps us then when we get to closing, because it cleans a lot of, we clean that all up and we drew things down. The closing costs are smaller. It gives you a little wiggle room when we get to that point, which is nice because you're expecting this cost. You know it's not going to be higher than that. You've budgeted for that, and then it comes down, and then you have a little extra money, hopefully, in your pocket. So, yeah, I don't want to say we're the best. We're good.
We are the best.
But I just, you know, whatever. I just, you know, we would love to earn your business. Hopefully, as these videos get better, and we're not trying to be internet superstars. We're just trying to make some videos for our clients. And as we delve into this more in depth, we're going to chop these up and hopefully have them shorter segments so that we can use them as ways to also answer questions that clients have. You know, I can, if they have a specific topic they want to talk, you know, they have a question on, I can shoot it to them in an email or a text saying, hey, this answers your question.
Right.
Then they don't have to spend time on the phone with me if they're busy, because that's the biggest thing. People don't want to be on the phone with you anymore. So they don't want to listen to you ramble.
Right.
So this gives us the ability, we're hoping that this will grow and we'll be able to make a lot more videos that are more narrow topic. And that a couple things that I picked up from this today is, you know, we should have had a couple things prepared, but that's okay. It's, you know, live and learn. Better to jump in and make mistakes than to not do it at all, as they say.
Absolutely. It's all part of the journey.
Right.
All right.
How long have we been going for, Ricardo?
Yeah, we're at the hour 20.
Oh, okay. So we went a little longer than we kind of planned. That's right. Now it's turning into a podcast, hey? So let's go off on a little bit of a tangent here. We'll finish on this. Difference between a nonprofit and a profit.
Yeah, nonprofit and a profit.
So I've gone to
Wait, let's clarify that. Hold on, please. Non-profit mortgage company, supposed nonprofit mortgage company, versus a for-profit mortgage company, right?
The difference is how you registered yourself with the state and the feds. So there are a lot of, I kind of noticed this about 8 to 10 years ago. There was an insurgence, for lack of a better, I don't even know if that's the right word. That might not be. There is an increase in the number of nonprofit lenders that were coming up, doing focusing on certain programs. And the reason I kind of stumbled onto it was as I was going to some trainings for VA, USDA, FHA, and I don't remember, a couple other programs, but some CalHEFA and some other things like that.
Right.
And I'm in this room, and the room is filled with all these people that are very proud of working for a nonprofit, but they're all loan officers. And I'm hearing them talk about their comp because, you know, everybody likes to brag. And
Their compensation,
here's
right?
the thing. Yeah. And like they say about a realtor, if you want to, you know, a realtor is going to tell you, oh, I made, you know, 60,000 on that last deal. But that's what they made for the whole year, because that might have been their only deal for the whole year. They only
Right.
made 60 grand, and of that 60 grand, they didn't even get all of it. So, you know, that's the same way with loan officers. You know, they'll have a big month and then they'll have 3 months of nothing. But you know, they're sitting there talking openly about their comp and this and that, and I'm going, wait a minute, you guys are a nonprofit. Why are you guys making so much? You're making more than I charge. And I think that gets into the guise of things. And I kind of saw a lot of this stuff go on when I was a wholesale AE. You know, you'd see certain groups target certain groups. You know, they target their own group because Group A trusts Group A, right? You know, you trust people. Most people trust people that they're the same. They think that they have a connection with them, and sometimes that's not the best connection to have. Sometimes people use that as an advantage in the selling of it, and there's a lot of laws against it, but it still happens. They focus on a certain group. Now, back in the day, that wasn't considered predatory, but now it is, actually. So you can't just go after a specific, you know, it used to be you could redline areas. Like, you know, redlining is when you box out an area and you say, we don't want to do business with people in this neighborhood for whatever reason, color, race, creed, whatever reason, right? Or so then it changes, like, no, you got to do business with everywhere. One. And then it turned into targeting, because people realize, well, if I go into this community that's underserved and I focus on it, you know, they're going to trust me. And that's where you have to be careful, because you're going to have somebody that has a lot in common with you, and they may or may not, you know, I'm not going to say everybody does this, saying there's a small percentage of people out there. And I kind of feel that, I'm not going to say that all nonprofits are doing this, but my interactions with listening in on, just sitting back and listening in on all these people brag about, you know, how much they were charging, kind of made me question, you know, how charitable they are. Let's just put it that way.
Right.
And as we know, a nonprofit, you know, just means that the company isn't making money. It doesn't mean that the employees aren't.
Right. The employees aren't working for a nonprofit for free. The employees.
Well, there are nonprofits that have people that are volunteers, right? So
Sure.
that's a type of a nonprofit. There's other ones that have employees, and those employees are getting paid a certain amount.
Right.
And you know, like back in the old days, how you used to say, oh well, you know, government employees deserve all these benefits because they're below market. Well, then the market caught up, and now government employees are paid above market, plus they have great benefits.
Right.
Generally. And that's a stereotype. It's not always true. I know there's a lot of civil servants who are underpaid and don't have the benefits. But there are a lot that are doing really well, and nothing against that. I'm not against people doing well, but
No, of course
that
not.
also happens in nonprofits. It's you know, you hear about these people that set up a nonprofit and for tax advantages, you know, and sure, they're doing good work, but you know, they're getting paid millions of dollars as, you know, as any other CEO might be getting paid in a for-profit. So they're not doing it at a reduced fixed cost.
True.
They're not doing the, what is it, the Ben and Jerry's model where the highest paid employee can't be more than 10 times the lowest paid, which I think that's even stopped at Ben and Jerry's or whoever. It may not have been Ben and Jerry's that did that. It might have been a different company, maybe Starbucks or something. But I know there was companies out there that used to brag about how their highest paid employee is only 10 times what their lowest paid employee is. So just be cautious. Don't trust an organization just because of the way they advertise.
True.
That's all I'm saying. I'm not saying they're not. I'm not saying you can't get a good deal for a nonprofit. I'm sure you can, and they may offer some products that I'm not even able to offer. But shop them, just like you should shop me. You know. And when I say shop, I don't mean go out and talk to 50 people. I mean, compare it to 2 or 3. You don't even have to talk to people. It's easy to shop. You can go online and see what rates are like.
Right.
Just be careful with some of those rate engines. Man, I've seen some games in that.
It's true.
We can maybe get into that on a different.
Yeah, that'll be a different one. Different episode.
Yeah, that'd be interesting. So, any thoughts from you with regards to it all?
No, I mean, we pretty much hit on the nonprofit versus for profit. You know, it all boils down to finding the right group of people and that can help out and have the experience to close the transaction successfully for you. So, you know, not just slick, you know, a fast talking salesperson that's going to tell you anything you want to hear. You know, that probably not the best
type of structure. It could be in a sole proprietor or corporation.
Right.
It doesn't matter what the function of the company is.
Right.
You have to realize is that they're all salespeople,
right.
regardless.
Yeah, you want to definitely partner up with or find the right, I guess, employ the right mortgage brokers or mortgage loan originators to close your loan successfully. That's ultimately what it comes down to, and provide you great level of service and communication. So
I think next time what we'll cover is the loan process. I think that's a good third video.
Yeah, our next one we'll go over that. Loan process is coming up on the next podcast. So thanks for tuning in. We appreciate
thank you,
your
folks.
viewership.
Hey, don't forget to say what do the kids say? Like, share, subscribe.
All the YouTube-y, all the Facebook-y, all the.
Tell us how dumb we are.
Yeah, even leave a comment if you don't like us. You know.
Yeah.
It really doesn't matter at this point.
That comment is as good as a good comment.
Right. We'll take it all in strides. So we appreciate you all tuning in, and as we get our little podcast, mortgage podcast, you know, figured out, and we look forward to sharing more topics in the future.
And I'll try not to look like I have jaundice in the future. Sorry, I've been traveling a lot, and I'm not in a position where I'm able to actually set up a nicely lit room or anything. You'll see me with just this wall or in the kitchen or wherever, depending on where I'm traveling, because I'm having to take care of some family members, so I'm all over the place.
Right on. All right, we'll see you on the next stream. Thanks for tuning in, Al.
Appreciate it.